Hello listeners and welcome to the Montel Weekly podcast. Today, joining me, Richard Sverrisson, is Bacila of Alpiq, a coal expert, and Trine Braathen from Kinect, who is a carbon market expert. Thank you very much for joining me. It's a pleasure to have you here.
Thank you very much. Thank you for the invitation.
I'd like to start off by talking about the developments in your respective markets, because it's been quite a topsy-turvy last 6 months to a year. So, Dan, if I can start with you and say, if you can highlight the main developments in the coal market in the last sort of 6 months to 12 months, and what are the reason for a certain downturn in prices?
What we have seen is that the coal price has basically fallen from $80 to $100 per ton to $60 at current levels in the market we see today. And the main reason for this has been a strengthening of the global coal supply and demand balance due to a mild winter overall in Europe as well and in Asia, and also let's say some kind of improved environment for miners to mine more, first of all, and second, we did not have any supply disruptions in the global market. Mm-hmm. So overall, everything has pointed or left more coal supply available in the system, both on the stock side from consumers and more coal being exported by producers. Mm.
So, I mean, China's quite an important part of this, isn't
Exactly.
it? Could you explain a little bit about the role China has in the pricing of European coal?
The main role that China has is especially related to its coal production domestically. Mm. What China has been doing in the past 2.5 years has been to invest more into its mines, into the coal mines in China. And what we have seen is now that China has actually it owns at the moment more coal mines, more advanced coal mines. It's only also available or able to produce more coal. So therefore, higher mining capacity leads to more coal production in China. As a result, the Chinese government also has its own preference, let's call it, for the price they should see in the market. And as a result, each time the price falls out of the band that the Chinese government wants to have, they play around with imports, meaning they either open the tap or close the tap for coal imports coming from especially Australia and Indonesia and other markets. So this is what happened this year. In the beginning of 2019, the Chinese government decided to put a stop on coal imports, as a result leaving more coal available into the Pacific market and ending up depressing prices in the area. In Europe, on the other hand, as you can imagine, since less coal from the Atlantic that is supposed to feed Europe is now available overall, ends up with improved supply in the basin. And if you combine that with mild weather and lower consumption, you get the API2 at $60 per ton.
And this could be set to continue?
I would be cautious in stating that, since now if we look at the level itself, we have seen this level back in 2015, but you have to consider where the oil price sits today compared with where the oil price was sitting back in 2015. That was $45, now we see $70 per barrel, which is of course supporting the production cost in coal. So therefore, I would say that these levels, or in a way, are very, very close to the production costs that we see, especially from miners in the Atlantic, like Russia. And below these levels, then it implies that the market will have to stop mining. Basically, we should see supply destruction everywhere in order to rebalance the global coal market.
Because you had some interesting numbers. The total market size is about 7 billion tons. China produces domestically 3.5 billion and imports 200 to 300 million. Trine, moving on to carbon now. Not so many global factors involved in driving the prices here, but it's certainly been another topsy-turvy year, and I think we're at our fundamental price driver conference, and you highlighted some extreme cases of volatility. Now, what have been the main drivers in this rollercoaster year, if you like?
Yeah, it's a lot of different factors playing in here for the price development. But I would say mostly the main factor is actually the sentiment and all the price outlooks predicting increased prices and keeping all the speculative trading activity with the increased volumes and positions in this market, really driving the volatility and really increasing the spreads we've seen. So it's definitely one of the biggest factors, but we've seen Of course, the UK and the Brexit development the past 2 months, we see the market is reacting heavily to news related to this, and all the upward movement we see in the past 2 months is related to the delay of the deadline of the European Brexit or the UK Brexit. So, of course,
and the downturn has been the confirmation of the fears of a no deal Brexit.
Yes, basically. So this political game is playing a huge role in the price development on a daily basis, and also triggering. We see kind of the technical trading activity in this market is heavily influenced by all this activity, basically, and we see these trading levels being broken, both on the upside and also on the downside, is triggering further positions. So it's a very interesting market to follow at the moment, because it's a lot of things happening. And just today it's actually broken the key resistant level at the 26 euros per ton, and which makes it very interesting to see the development, if it corrects down within the next couple of days, or if we actually go into a new trend line.
It'll be very dependent on news about Brexit, I suppose. Yeah.
Yes, of course.
But so it's quite interesting here. You're both analysts, but you're saying also that analysts have partly driven this market upwards. I think there was some crazy numbers out there: 100 euros a ton and 65, 45. So that's quite interesting. You also mentioned here earlier, Trine, that the number that speculators were trading in the markets, 160 million tons you mentioned. Could you explain that number a bit more? What kind of percentage of the total, or what does it represent on a daily level?
Yeah, we see this. This is, of course, a difficult number to estimate. It's very difficult to know the exact number, because we do have a lot of banks coming in, which are not the traditional compliance market players. We do have the traders, basically trading firms and so forth, coming into this market, and also the pensions and hedging funds with a much longer term view on the market, with a lot more long-term investments compared to the day-to-day trading activity. Yeah, it's interesting to see.
Is it something you can see in the coal market, Dana? The role of the speculative players or the financial players? Is it hard to? Because I know there's a lot of banks trading coal and
not anymore.
Not anymore. Okay, they've moved out as well. Okay,
that happened many years ago. Basically, that's why we have.
I'm out of date. Shame on me, but they certainly provide a lot of analysis, Dana, don't they?
They did, but that's why they are not doing it anymore.
So yeah, again. I need to catch up here. I need to speak to my colleague Lawrence Walker, and he'll keep me up to date. Yeah.
Basically, in the coal market, what we do have are the players that are actually interested to do some real business as well, and we have not many of them left. That's why the liquidity is very, very low, and some trades can actually induce pretty big price changes on a day-to-day basis, depending on the presence of those players. Utilities, big producers that we know of in Europe, so they are the ones active in the market. Less banks have disappeared.
But there are some big, I don't know if you call them, trading houses, such as the ones who congregate, some Singapore-based or Geneva-based or even London-based.
They are the ones actually still involved, but their focus, of course, is also spread, let's say, towards different commodities, I would say, not just coal. So I would stick to the big producers and the utilities being the most active in coal. But liquidity is pretty low.
Pretty low, yeah.
Yeah, most of that you have on the front year contract, and the others are less liquid.
How about transparency? Because that's been the coal market's been criticised for being quite opaque in the past. How does that? How is that now?
It's not changed, which of course for a coal analyst It's still a pretty difficult task to be able to understand what's actually going on on the ground, since you don't really see many things. And
but that's why people are very dependent on your analysis, then, don't they?
Exactly.
Mm-hmm. We talked a little bit about. You both mentioned the downturn in demand for coal in Europe. Would you say, Dana, that it's driven by the ETS?
That's part of it, especially since theoretically, yes, the coal price would be negatively impacted if we have a higher CO2 price. That's the direct impact. But I would say the main thing that has been, let's say, killing coal consumption in Europe has, first of all, weather, renewable output. And despite the fact that, for example, this year we have even seen lower hydropower generation, which would have implied we should see more thermal power, coal and gas, apparently gas has kind of gained a little bit more, while coal lost much more in terms of the percentage changes. And the reason for this, I would say, is the fact that the price levels that we see for the fuels today, along with the CO2, has led to a stronger competition between the fuels, especially if we think about the power market in Germany.
What are the key drivers here in terms of a day-to-day basis? Are they looking at the clean dark and the clean spark spread, i.e. the profits from generating coal and gas? And they can vary from day to day. So when you say strong competition, I'm just wondering what exactly you mean here.
I'm mostly referring to the coal to gas switching that we have seen, and where the price of coal is located into this switching range. If we look at it in dollar per ton, we could of course look at it in euros per megawatt hour as well, if you look on it from the gas terms. So what we have seen is that due to the decline in the gas prices that we have witnessed this year in Q1, we have seen stronger competition from gas in the power market, which of course puts downside pressure for coal. Of course, a higher CO2 price would definitely be supportive for improved or higher gas power generation compared to coal power generation. But what I would say we can witness today in the market is a stronger interdependence between these three, and kind of keeping the price levels within the switching range.
So it's more an interdependence rather than one or the other, in a sense.
Exactly.
Yeah. How do you view this, Trine?
I think the political side of this is kind of really relevant because all these countries having these phase-out plans for coal, I think this is kind of putting the sentiment in the market and also contributing to lower investments in Europe. And we see as coal is polluting more compared to gas, with lower production from coal, then basically in the long term you would have less demand for EUAs and carbon allowances. So
that could drive the price down then, in effect, you say?
Yes, in the long term, definitely.
So coal exit, lower carbon prices. It seems sort of counterintuitive. We've discussed this before on the pod as well. But.
Yes, and in my opinion, it really depends on how the government actually act on closing down these coal power plants. If they choose to actually voluntarily cancel the allowances, similar the amount of emissions from the coal plants, then of course it wouldn't be a bearish factor for the carbon price development. Then it will be more neutral. But of course this is really difficult to predict because it's such a large investment for all of those different countries and governments to really do those investments in purchasing the allowances and then cancel them. Which
it's like burning cash.
Yes, basically.
And what economics or finance ministry would do that?
Yes, and it has a really high cost for the government to do this. So it will be really interesting to see the next couple of years which countries actually going for this strategy and who's not.
Could I ask you to pinpoint a few where you think it's most likely?
I think it's likely that Sweden would go through with this strategy. I think Germany will have a lot of pressure on their side to actually execute this. I'm a bit hesitant to exactly estimate the numbers there. I don't believe they will do it for the 100% volume, but maybe for some percentage in there, which will support the prices. And of course, I believe France will go ahead with this cancelling of free allowances. But of course, France don't have those emissions compared to Germany. So again, Germany and Poland, for example, will be those two nations we're really interested to follow these kind of discussions. Yeah.
Of course, because Poland doesn't really have the choice to switch to gas, in a sense, because it's 90% dependent on coal-fired generation. So I think there's quite a disparity in the options available across Europe and to switch from coal to gas, if that's a fair assessment. But you, Diana, you mentioned in your presentation earlier as well about the certain amount of greenwashing that's going on here, and some miners in particular are mentioning that no, we're not going to mine, we're not going to open new mines because we're going green. But do you think there's something else going on here?
Well, first of all,
not naming any names, of course.
First of all, we have to consider the capital flying out in a way, the capital acts. I mean, with miners or producers of coal and also utilities now are facing some eras where the investors are running away from coal, right? As we have seen even the Norwegian pension fund coming out 2 days ago saying that they will limit production of, put caps on the production of thermal coal and coal power generation. So this is one thing that, first of all, in a way prevents producers to put more money into developing mines. But second of all, if you think about demand, as we have mentioned, and especially long-term demand when it comes to the coal exit in Europe, when it comes to China moving away to more cleaner technologies, when it comes to all other countries trying to switch to cleaner fuels or investing more in renewables, we kind of have a consensus in terms of where coal demand is going, and that's not a very positive trend, let's say. Therefore, it would be wise for you as a producer to basically not mine more in the front in order to kind of deplete your mines, but wait a bit and kind of distribute this production for longer years, as that will give you even higher margins on the longer term. So that would be
by saying you're not going to open new mines, you're not saying you're going to give up coal mining, you're just saying you're going to wait a few years until you sell it. You're basically, when you're saying that you're capping your production and you're not investing or opening new mines, what you're saying is that this basically gives you flexibility to mine whenever you find the price gives you the higher margin, I would say. Sure. So then I would say that all producers should now be more, careful or cautious in not repeating what we have seen back in 2015 when everyone was mining a lot. We got too much coal, prices were facing a strong oversupply. However, these days when you see that demand is pretty sensitive to that, you would be better off adjusting or being able in a way to adjust your production. We're seeing obviously Europe moving away from coal, not fully away, and the USA, mainly due to, carbon pricing initiatives, but also some political moves. In the USA, it's happened more because of the economics of gas. Where are the growth areas for coal in the world?
Well, we will still have China.
And you as an analyst? I mean, where can you? I mean, if Europe is kind of dwindling, then where is the growth areas? Is what I'm asking here.
I can tell you one thing: I'm not moving to China or India.
Okay, that's very reassuring because we don't have conferences there, Diana. So that's perfect. Yeah.
So, but first of all, if we think about where is the growth sitting nowadays, we still have China, which will kind of keep the lion's share of this market. But China is also investing or growing its energy balance with other technologies, especially wind, solar, nuclear. China wants to become the biggest nuclear power producer in the world, and also gas, of course. As we already seen, has started entering the Chinese market, especially to replace coal during the heating season. So that's what we have witnessed 2 winters in a row. Other countries would be India, But India also has its own coal production domestically, and they're trying to mine more in order to reduce dependence. But countries which plan to grow their economies using coal power are the ones located in emerging economies in Southeast Asia. And there we have, along with India, Bangladesh, Pakistan, we have Indonesia, we have Vietnam, we have Thailand, Malaysia. So all the countries, these countries are still basically relying, as they can't really afford now to price carbon or to get rid of coal. But another thing that I want to highlight is the fact that if you look on the plans for investing in coal power plant projects in the future, each year these plans are cut, slashed, left, basically, just because it's much more productive, or let's say cheaper, if you invest in wind
or solar. These are very sunny countries. Yeah,
exactly. So that's the thing here. That's in a way the risk going forward, that this pipeline of projects shrinks and narrows as we move along.
Because the fear of locking in some very expensive investments that won't be needed in the future.
And overall, in the future, everyone would basically move into where Europe is now heading into exit and pricing of carbon everywhere, imposing carbon floors. But we can't talk about these things now for the emerging economies, of course, but
in the future,
we have to look on the 30, 40 years.
Because that's a good point, I think, Dana. You mentioned as well, Trine, the different ETSs around the world. I mean, how far are we away from a global carbon price?
I think it's in this direction we're heading. I think it's many years before all the different market mechanisms are linked all together. That's a long way ahead. But we see that all of these national and regional market mechanism is entering into force every single year. In actually all continents, we see them popping up. And of course, when China is introducing its carbon market in 2020, it will be the largest operating carbon market and will have a significant impact on also the development of new similar initiatives in other countries, for example in Asia.
Interesting. I mean, if we can sort of finish off by talking about sort of more short-term drivers, and for our listeners, what do you think will be the key areas for the remainder of the year for carbon prices, for European carbon prices?
Yeah, it's of course difficult to answer, but in my opinion, the Brexit is still a very hot topic, and it could move prices potentially in both directions.
Even if it's extended to the end of the year?
Yeah, in my opinion, depending on the outcome.
Sure.
Of course, if we have a hard Brexit on Friday, potentially, then of course we could risk of having a large sell-off in the market, which put a very bearish pressure to the carbon price. However, in the long term, if we see a year from now, a hard Brexit should actually support prices in the carbon market due to the fuel switching activity in the UK, actually contributing to the surplus of allowances in total in the European Union. So, of course, the Brexit is really one of the main or key drivers for the carbon development the next year. But I will also kind of mention the political framework which entered into force in January 2019 with the Market Stability Reserve, which is really affecting the auction volumes and the supply of allowances. I think this is one of the main drivers for the price development also in the years to come, including 2019. And this is, of course, a political market, and it will be reviewed in a couple of years. So we could potentially have changes to the current framework, but at least some of the uncertainties we had back in 2016, 2017 is not there anymore. So this is really kind of supporting kind of the long-term outlook in this market.
and the political pressure is only likely to build further. I mean, there's already calls on the EU to increase its ambition for carbon reductions by 2030.
Yeah, we see this very clearly in all countries in the European Union. They are under very high pressure from stakeholders, including environmental organizations, the population in general. So this is a global trend, and it's especially evident in Europe, where they are striving to increase their ambitions and their environmental targets, and of course this is affecting the price developments as well, and the sentiment and the price expectations in the future. So yeah.
Excellent, perfect, thank you. And Diana, is it all about China this year, or there must be other factors as well?
It is all about China, and I think we should definitely take a very, very close look at all the policies that the Chinese government is coming out with. And at the same time, we should be careful what is going on the producer side, trying to kind of understand if they really adjust or
on the Chinese production of coal or global coal production.
Basically all the producers, how they respond to the price level that we see today, because overall it's $30 down from the beginning of the year in the end. So there should be something happening slowly, of course, because we are talking about coal. We can't just open a tap or close it. It's mining, and that's a more difficult or process or lengthy, let's say. And at the same time, we should keep an eye on gas, how gas plays out with coal. Of course, the CO2 remains big driver this year, and has been both for the fuels and the power market itself. So I would say China, cost of production or producers' behavior to these price levels, and the gas price and how coal to gas switching reacts combined with the CO2 would remain the main important drivers to follow in 2019.
So certainly enough to keep analysts and journalists very busy.
And in Europe.
And in Europe, of course, exactly. Diana and Trine, thank you very much for joining me today. An excellent discussion and an interesting debate about what have been the drivers and what to look out for going forward. So this is Richard Sverrisson signing off from the Weekly Podcast. Please remember to keep yourself updated on Montel News, and we're on Twitter and LinkedIn. Thank you very much.
Thank you very much.
Goodbye.
Bye.